traders, happy Tuesday. Welcome back to the final hour. Just let me get a quick message sent out here. 3 p.m. final hour. Is the bottom in? I don't think so. Okay, so really easy number you can find in your TradingView charts. It is the Shiller price earnings for the S&P, and the only time we've been more expensive as far as valuations was back in the dot-com, right before it burst, 2000, 2001. So I want to show that. Price action today, pretty quiet. S&P flat, 0.11. SPY, 0.17 in the red. Nasdaq, 0.13. Q's, 0.10. Dow, 0.26, a little bit lower. Russell down 0.05. VIX still red on the day, but I would imagine that the VIX probably had some wicks to the south. Let's have a look. A little bit. That's the weekly chart. Let's look at the daily. So red for the VIX. It's a pretty big volatility crush. Down about 52.66% from the high on the 7th. Hopefully there's a little bit further to go on the VIX. We'll see. Bond volatility. This is another thing that we would like to see go lower. The higher this goes, not good for stocks. So if the bond volatility decreases, it's probably a good environment for bonds to continue to show some type of resiliency and stability off of Wednesday's bottom, and see if we can keep building from there. SVXY, I was up about $1.30. I might end up dumping these shares and just getting rid of them to keep the buying power. I got rid of some puts today. So far for the week, I've talked about this. Any type of upside move, especially since the bottom last week, de-risking and deleveraging. And right now, Microsoft closed for profits. Coinbase closed for profits. IBIT closed for profits. Apple closed for profits. Netflix closed for profits. And then a new earnings trade. That's part of my newsbreaker service. We took a trade on Netflix going out to the first part of May. Priced it in accordingly, looking for some volatility. Palantir, this should be full profits by Thursday. I sold a lot of premium on Palantir all throughout 2024. A lot of those I just got 60 days, 90 days, 120 days out. I did leaps on some of those ratio spreads, and they all expire on the 17th, which is Thursday. So that should be full profit. I need to look at a trade. I closed out a SPY naked put, closed for profit. It was up about 82%. 82% of max credit. I've got some other ones that are trading around 65%. I'm going to let those ride a little bit longer. Same thing on QQQ. I have a SPY 111 that was closed. Let's see here, 301. Closed it down for 25 cents. Took about 85 to 90% of profit there. And I want to see if SPY this week, I'm looking at a roll on MO. I'm looking at a roll on KO for Coca-Cola. I'm looking at a new collar on natural gas. I'm looking for a new collar on uranium. And I looked at earnings this week. I didn't really like anything. We have United Airlines, Interactive Brokers, JB Hunt, ASML, USB, ABT, PGR, TRU, AA, which is Alcoa, KMI, Kinder Morgan, UNH, HBAN, Huntington, AXP. That's what I'm watching, but I'm just looking to see if it stays above 260. DR Horton and Netflix. So earnings this week, I'll run through the list. UAL, I tried to price it in. I didn't like it. IBKR, watching. JBHT, ASML, USB, ABT, PGR, TRU, AA, KMI, UNH, HBAN, AXP, DHI, and FLX. Okay. So I want to take a quick peek at some of these. Since we have an expiration on Thursday and some of these have earnings this week, I might be able to look at selling some premium as we're still in a somewhat elevated volatility environment. So if I can sell some premium, have it expire by Thursday, grab a few bucks, I'm looking for something that's relatively low volatility. Let me take a quick peek here. If I go to IBKR, which is Interactive Brokers, it's traded for about $173. Average move for earnings is around 6%. I'll say 7%. Let's be on the high side. Let me see what, let's go IBKR. So let me take a screenshot here. Okay, let's go to IBKR. Trading at 174. 54.6 IV rank. Earnings on this is today after close. So if I'm going to take this trade, I'm looking at it right now. Strikes are not awesome. If I sell a 175 and I sell a 175, I get $11 for what should be a $9 move. What's about a 7% move right here? So 0.07 is the average earnings print times 174.89. It's about a $12 move in earnings. So I'm getting $11.35. Average move is around $12.24. I'm not quite getting enough premium to sell this and hopefully pull in the credit that I'd like. I could do this. I could go 175 to 165, 175 to 185. So I could sell for 725, have a nice profit for a small risk. It's defined risk, doesn't take up a ton of buying power. If I go a little bit wider, it's a little bit more risk. So I could risk $592 to make 908. If I tighten this up a little bit, that only gives me about $10 a movement one way or the other, plus or minus $9 on this. And average move is around 6.93%. We have a lot in the 5s and 4s. Let's say that we have a 5% move. That's $8. It's still not quite enough to get the credit that I want unless the thing just doesn't move. So let me see if this happens within a 2-day expiration. Let's go post earnings. 1 day, 8%. That would bust up my trade. Within 3 days, 4%, 1%, 2%, 4, 4.98, 0.75, 4.84, 6.91, 1.08, 1.45. I mean, there's a lot of 1 to 3 days that are less than expected. This isn't a bad move here. Earnings. I guess the question is, am I willing to risk? I don't like the expiration here because if I take the trade today, I mean, the good thing is I get the time decay. The bad thing is the price does something immediately out of day one. Let's say we have a big gap up or down tomorrow. I could be busting that move up. So I need price to stay within about $7.20. $7.20 divided by 174.83. I need about a 4% move within Thursday, Wednesday, Thursday. 4% move. It's going to be close. I mean, I do see a lot of moves on IBKR that are less than 2%, 2.3, 1.71, 1.08. Post earnings open, 3.1, 1.96, 3.47, 4.08, 4.37. And I need this to be what? $7.20 divided by 174.84. So I need about a 4.1 or less over the last, let's say, 10 earnings. Dean, good work. So 4.1. I don't know. Maybe I think my super high volatility window has changed. So I like the trade, but I'm probably not going to force a trade here. Let's go to something else. Let me just do a quick run through UAL. I'll float these out and see if I can find some key levels that are just standouts. UAL. maybe a little bit of upside potential going into earnings. IBKR, kind of neutral. JBHT, also kind of neutral. Don't love it. ASML, we're kind of stuck right on it. Not something I see working out. USB, scattered around, just not enough. ABT, not enough. Progressive, this one might not be awful. Let's check PGR's Progressive Insurance. 38.7 IV. Back up near the highs again. Let's see. I don't think it's enough to just straight up sell premium. I would imagine earnings are going to be pretty decent, but I don't know. Their guidance might be interesting. I mean, I'm sure people have got to be pretty pissed about their insurance in 2024. It just keeps getting more and more expensive. Car premiums are up like 50 to 55% the last few years. Homeowners insurance is more expensive. Medical insurance is more expensive. I mean, it's just not great. Insurance is just jumping way higher than it probably should be. It's way outpacing inflation. It's ridiculous. All right, let's keep going. PGR, TRU. Still not enough to get me activated. Alcoa. Anything? Not really. Maybe down into the 23 strike or 2250 strike. It's kind of trading right in between. Just don't really have any major outliers. I could see price going down a little bit on Alcoa, but this might be a trade for if we come down to $23, maybe looking for a chance to buy a dip. If we come down here and then we can bounce off that, I might look at a credit spread to buy or put in a credit spread on Alcoa around the 23 to 2250. Are your upper and lower levels on Netflix? Yeah, roughly, Nate, because I'm just going break even. So I put it at 1045 and 915. If we're beyond those levels, that should be looking pretty good. But you're talking about levels that are break evens. So yeah, that's one way to mark it up. KMI's Kinder Morgan. This one, I could see this one looking pretty good. Kinder Morgan, when do we have earnings on this? KMI. KMI at 27. This is energy. Interesting. Let me see what this one looks like fundamentally. Okay. So I like this little play. Let me see if I could price in. I think these levels look pretty attractive to at least try to find some movement to the upside. Let me see if I go into KMI. Earnings is tomorrow after market. Let's see if I can get a bull call spread. If I buy, sell, 30 cents to make 50. If I give it about a 12-cent head start, can we get up to 28? My strike price is, that is $28. That is $29. That's three. I mean, I would like to see this thing go up into these areas. So directionally, maybe like a 27. So I can spend 21 to make 29. That's not a bad trade if I can get the fill there. This one's a little bit safer to trade because we're pretty much, we need price to move about 12 cents, and hopefully we're going at least 62 cents to the upside. If I did a credit spread, as long as we hang out above 26, I'm getting 15 cents in this one. I'm getting 20 cents in this one. Make 20 to risk 30. This one, 35 to make 15. That might be my better trade out for 2 days. This is after market on Thursday. Let's see. We need to move up about. So my break even would be what? So this one has a break. I'd actually be, if we stay where we are, I make a few cents in this one. I don't like the negative reward to risk, but I don't require price to move that much either. It's honestly like not that great. I mean, I could risk, if I'm willing to risk $70 to make $30, risk 100 to make 45. Probability's okay. I like the levels to the upside. It's cheap enough if I just buy a 27. Now, if I buy an in the money call, see, buy a 27. We're only looking at about a $1 move. If I buy a 27, sell a 29, I get nothing for it. Yeah, these premiums are just, they're kind of crappy. So I like the trade. I just don't know if the options are that good to take a directional play. I think there's room to get up here. But to do it in 2 days and only expecting about a $1 move, I'm just going to say not good enough, but I'll watch and see. Head and shoulders measure move would take us back to 72-ish. Head and shoulders move, huh? You see a head and shoulders move? What looks head and shoulders about this? You talking that? I mean, that's not a head and shoulders. That's just calling the bottom. Seeing if it goes back to 72 and 50, 72, 72, 50, maybe. That's if we have a bullish pattern. Do we think that the world wants higher prices right now? I don't know if we go anywhere. I don't think we go anywhere other than stay here, and we just have a big chop fest on oil. That's what I think. Hourly chart. Yeah, I guess. So if there's some follow through on oil, there's your move, 71.55. Yeah. But this is not where you call it though, right? I mean, what you want is if we're breaking above this level, then you get long. I wouldn't call it now. If we're above this neckline, then sure, get long. You got room to trade to 71.50. But if this goes right back down to the lows again, well, now it's maybe a double bottom. So we're still not out of the woods yet. We're still below the 200 moving average on the 1 hour chart. I would be looking for price to give us something to the upside. Price breaks, yeah, we got bullish. Price doesn't move, you're just anticipating. All right, what else do we have for some earnings? That was KMI, UNH, United Healthcare. This one, back and forth, no trade. HBAN. Maybe a move up about 50 cents. It's like I'm not getting excited about an option trade with that. AXP trading at 258. Kind of mixed. We got a little movement up to 265 and potentially 250 as well. So this is a toss-up, either down to 250 or up to 265. DHI is home builders. Let me see what IV is on DHI. 56.7. Let me price this one out really quickly. Earnings on the 17th. This is before open. So we can still trade this on Thursday. So average move is about 9%, plus or minus. This is 17th before market. We've got expiration end of day. Expect to move about $5.50. We're trading at 119. That's only Really? Sheesh. 555 divided by 119.86. It's only about a 4.6% expected move. I've got an average showing that 9.53, 11%, 8%. So I almost think this one might be a good one to play directionally long. I hate the IV rank at 55, but is it cheap enough? If I buy a 120, buy a 119, cost me $5 on what hopefully is, let's see, before I price this one in. So I have an average move of around 9.53%. Let me go to a little snapshot here. DHI is not in here. So I am seeing earnings post price within 1 day. I mean, the average move is around 9.53, but I'm going back to a lot of single digit movers. And what did I say this was? 555? 555 divided by 119.75. So that's about a 4.6% move. Let's see how often we've gotten to at least 9%. Okay, so if I went out to, I just don't think we're going to get there in 1 day. Let me see if I sell a 119 and a 120. This one almost covers the entire move. Let me build this one out really quickly. I might take this trade here. Let's go DHI. Okay, so if I go to April 17, sell the 119 call. So sell the 119 call and sell the 120 put. Okay, this is my trade. One standard deviation, we'd have to have outside of a one standard deviation move in order for this trade to be threatened. Pulling in about $6.50 to $7 a credit. We're kind of right in the middle. Not bad. If I tweak this to current price is 119, if I do a 120 by 120, there's the trade. So the nice thing is if I take this trade outside of this premium, we wouldn't have any risk until we get below 113.70 or get above 126.40. If I tweak this for just a little bit larger, I'd sell the 119 call, 120 put. Now we can go a little bit wider with this. Now we've got a 113 by a 126. I kind of like this trade. So I've got to put a spread on here. So expected move is around 555, but percentage-wise, I wish I could have an average 1 day percent move. On the high side, very, very few times is this greater than a couple percent. So let me see. If I go 19 by, I just want to eliminate the risk here. So 119 by 126. So that's $7. And then a 113, that's $7. So I get a $5 move. Let me see if I can go a little bit wider here. 538. This isn't too bad. So let me add this in. Just to make sure I don't get stuck with some nasty volatility. I could just do nothing with the trade, but if it's a blowout move, I'm going to be, on the hook for some undefined risk, which I don't really want. Although this does cover the move, but just to be safe, Let me add the legs here. So option leg, option leg. So the 119 call, then I'll sell a 127. Or I'm sorry, buy a 127. 127 call, and then go 8 and 8. So that's 8 and 8 via 112. So then buy a put. Okay. Trade looks a little bit different now. But maybe I pin this around 120 and see if I can shift this over just a tiny bit. Let's go 120, buy 120, and go 7 and 7. See what that looks like. It's not bad. If we have a greater than 1 standard deviation move, there is some risk on the trade, but I've got a little above and a little below. If we stay in the middle, that could be pretty helpful. Break even at 115, break even at 125, pull in 4 and change. See if I can go out to 8 and 112. This should increase my credit a little bit. Now I pull in about $5. What's that reward to risk? So I'm risking $260 to make $438. It's not a bad trade. As long as price stays less than about 124 and stays above 115 or so, I've got some profit in this trade. If I shift it here, a little bit more risk. If I split it here, a little bit less profit. So if I go 120, that's 8 wide, 8 wide. That's right there. This has earnings. When is this trade? DHI? Earnings is before. So this is Thursday morning. Thursday morning on DHI. All right. Pull in $5. Pull in $6 on this one. So this would be 9 wide. A little bit more risk, but this one pulls in more than the expected move. I'm going to take this trade here. See if I can get filled for like $6. $6 and see if we stay there by Thursday. Can I get $6 on the trade? $6 no. $5.99. I'm just going to penny this down until it gets filled. All right, just got filled for $5.96. All right, this one's going into another Newsbreakers trade. So this is a 4/17 expiration. Sell the 119 call. Buy the 128 call. Sell the 121 put. And buy the 112 put. So collected $5.96 credit. Looking to see if I can keep that. So let me update this. So 119 call, 121 put, 119 by 128, 121 by 112. Should be correct. Okay, so here's the trade. Here was the trade. There. So collected $5.96 credit. If price stays right where it is, then by Thursday, a 0 DT trade, as long as price is kind of hanging out in here, then this is full profit for about $500. If we have a little tiny reaction, should be okay. This can go up as high as 123 or so. I mean, my risk is going to be one standard deviation more. So we'd have to have a pretty big move. I mean, it'd have to have some very negative earnings print or one very positive earnings print to break these standard deviations. So there's about a 70% chance that this trade still wins. I'm risking way less than I'm getting on the trade, so it's not a bad play. All right, so I'm going to take that trade. That's in. Let me get this trade posted. Sell the 119 call, buy the 128 call, sell the 121 put, buy the 112 put, $5.96 credit. This is a iron butterfly. Plus minus 555 by 417 end of day. Average 1 day move is less than 5%. Looking for price to stay within 124 to 116 area by Thursday for profit. We have 596 credit, shows 496 debit or lower. Look to protect profit. Okay, trade is in. All right, what else? Netflix, I already did that one. Okay, so DHI. We're going to see if price will stay right around 124 or stay around 115. There. So if earnings allows it to stay in here, that is good. Hopefully that's the case. If it blows above or blows below, the risk is contained. I mean, I'm looking at a trade that I'm risking $300 to make $400, and hopefully, probability-wise, a little bit of cooperation from a one DTE since the earnings comes out in the morning that day. It'd essentially be a 0 DT trade. So that should be quick. If price doesn't make a big move, it should be quick as far as that IV crush, and hopefully we can take advantage of that. Okay, someone's asking about Lyft. Take a look at Lyft. Lyft is trading at 1088. I own shares at 1179. If you like Lyft, which I don't mind it, I'm willing to buy some more shares somewhere in here. So I have some shares, and if it comes down to like $8, I'm going to buy some more. In fact, what I might do on Lyft, if it comes down to tag this 842 low, is I might look at a synthetic long on this one. Speaking of, Snap is down here. I wish that this would be just a little bit better off for profit. 2.5 price to sales. I mean, come on, dude. Fair value at 22. Could I position? I've got one account that has some Snap. And this is getting it called away for a couple of bucks here. May 16th, we get back to $10. Otherwise, I wouldn't mind adding that. I'm not sure what the buying power is, but I've got, if I did a synthetic long here, looking to see if I can just take this out a little bit longer. Let's take a look. If I go trade, IV rank still 83. That's way up there. We got earnings on the 29th. If I go out to, say, July, and I buy a call, sell a call. I can take that trade for free. My max loss would be $800, but I'm essentially owning 100 shares for a buying power reduction of 426 bucks. So I wouldn't mind getting long the shares here. That incorporates earnings. Is it enough to go anywhere? Am I just wasting money? Maybe. Let me see. If I go out to the end of the year, if I buy and sell, call's a lot more expensive. I don't love that one. Try to find the sweet spot here, October. If I buy and sell, this one basically cost me zero. Have a little bit more time. I'm long out to October. That gives me a bigger window to be right. About the same risk, same profile, $469. I don't mind this trade. I'm going to take this for a very small debit if I can. I mean, a credit would be great. Let me see if I can get like a 1 cent credit. $1 credit not filling. Let's alternate to a 1 cent debit. Okay, it shouldn't be any more than 5 cents debit. 2 cents debit. 3 cents debit. All right, I'm gonna add that one in. Snap. So I own the shares right now at $8.55. Oops. Okay, so adding synthetic long, sell. So buy $8 call, sell $8 put for 3 cents debit. And that is the October 17 expiration. So 10/17 expiration. There we go. $10.17 expiration. Buy $8 call, sell $8 put, 0.03 debit. This is a synthetic long position, like buying 100 shares, but only requires, so that buy power is there. Okay, so what's that trade look like? Take a screenshot of this one. Okay, so here's what the trade looks like. I basically long the shares. So there's risk to the downside. Yes, if the stock goes lower, there's gains to the upside, and I don't have to tie up as much buying power. So yeah, if it gets up into, $10, $11, $12, I mean, fair market value fundamentally shows 20 plus. That's encouraging, but maybe a positive earnings print would help. I mean, I use Snapchat. I see that there's a lot of AI stuff going on. I'm sure it's fun. There's a huge user base. It looks like they're monetizing a little bit better. There's like in your little contact thread, there's little ads and other stuff. So in some way, shape, or form, they're doing a better job of somehow monetizing it. It hasn't quite become Facebook or even other things that are monetized, like Instagram's well monetized, but IG is owned by Facebook, right? So anyway, we'll see. But I'm really looking to see if I can just repair the stock. Where if we're sitting here at these lows, I mean, we went down as low as 2018, 2019. This would have been a post SPAC move. This is down to about $5 or $6. So, I mean, if we're sitting here with support holding, it'd be nice to see it, come back to 10, 11, $12. Chart alarm for me is set to 13 and change. I'd love to see this come back up to a range level between $14, $15, and I'll let it go. So I'll keep a close eye on this one. Okay, I can try. I can push, and I think I put it down to like 720 from my previous computer. I've got a super computer now. Let's see if I can update this. I can't change it on the fly, but yeah. Shout out to everybody on Twitter. Got people watching on X. Got people watching on Chris Pulver Trading. People watching on Financial Wars. One person watching on Twitch. Who's my gamer? Who's my gamer watching on Twitch? Yeah, I'll upgrade it to like at least 1080. I'll go a little bit higher. Buy 8 put, sell 8 call. Yes, that's a synthetic play. Yep. I mean, you can also just buy the shares, but when I have a margin account, it takes up half the buying power to own the shares. So that's why I do it. Give myself a decent window. October is out around 185 days. There's earnings in April. So we have earnings on April 29th. That's for the end of the month. We're looking at a fairly bullish window now until maybe June, July. So if there's any upside here to, $10, $11, $12, I'll probably just dump the shares, take it for a few bucks, and be happy. Just a little income trade. So nothing crazy. All right, what else we got? I think that's it. Looking for rolls. I'll go back to SVXY where I started. Okay, so I added a trade on DHI. Added trade here. Added trade here. Snap, added trade here. The rest are earnings. I priced a lot of these out. I don't really like them that much. I priced out UAL thinking that that'd be a good one to look at. Let me see here on UAL. So I could look at something all the way down here, similar to what I did for Delta. If the premiums are high enough, maybe I could do a ratio spread on UAL and own it. But I probably have to go out to December or January in that one if I wanted it for an income trade. So UAL earnings the 15th. If I go out to December, January, let's see, $20 strikes as low as I can go, and we had lows here around $18. Maybe, but probably not. And go out to January, see if the option changes a little bit better. January. So the lowest I can go to January is $20. Let me see if this will update. I'm considering a ratio spread where I wouldn't mind owning shares of UAL. If I did a 28 by 25, turn this into 2 contracts, I make $73, but I could own the shares at a discount. That would be assignment at 25 if it's going to be assigned, which there's a low likelihood it gets assigned, but $25 assignment minus 3 minus 73. I'd own shares at 21.27. That's pretty cheap. It's not the COVID lows when the whole world was going to be like, nope, nobody's ever going to fly again. World's ending. But that's a terrible trade. I'm not doing it for 8 cents. I could try it here, but that's less credit, which is surprising. This one's a little bit more credit. There's still a 94% chance of profit on this one, but I'd have to own the shares, repair it, potentially take it down into I'd have to repair the stock for a $12. If it drops down to COVID lows, that's $18. I would own the shares around 27 minus $1.20 be 24.80. 24.80. I'd have to repair it for like $6. An at the money covered call on this one for about a month or so. Let's go out 30 days. It's, I mean, about a month I could repair it. It wouldn't be the worst thing in the world. But is that trade worth locking up the capital to make 80 bucks? Not really. I did Delta. Let me see what this trade was on Delta. I did a trade on Delta where the premiums were so high. I sold Delta for $6.25, and I sold these at COVID lows. So fundamentally, I like Delta a little bit more than UAL. Let's go between the two. United Airlines. Okay, 6.8 price to earnings. Fair value, trading at 62. Delta. Profit margins are lower, but okay. Has debt, insider selling it. I mean, but it was also ridiculously high. I mean, the airline stocks have come down like 40 to 50%. 7.1 price to earnings. This is what I like about Delta. Current price is 40 bucks. Fair value is 192. That's a big difference. If I go to SkyWest, this is the other one I consider, taking some ownership of. We're trading around price to earnings 10.7. Same thing here. So if I was looking at what airlines would I own, SkyWest, Delta, probably the most fundamentally strong airlines. I put in trades on Delta at $23 to $20 just selling puts. So if this goes well by the end of the year, that's 600 bucks. I'm already up 50% on the trade. So a little bit more, IV crush. This is an easy trade to grab. I'm not going to wait all the way to December. If this is up, $450 to $500, I'm just going to take the profit and move on and not have it tied up. Okay, so Delta, I sold lots of puts here, and these are all looking pretty good. So I'm already up about $1,900 in about a week, about 50%. So if this gets up to 70, 75, 80, 85% in the coming, let's say 30 to 45 days, I'm not going to wait 248 days to take my max profit here. I would instead just take out a majority of the profit and be done. Why would you buy any Snap now if you don't have any? I mean, I like it as far as it's cheap enough. It's been cheaper. It's come down to like $5 and change, but it's sitting at these range lows. I mean, I don't mind it. We do have earnings. You're taking a risk on earnings. But to me, I look at this as, this was the bear market in 2022. This is the COVID crash, and we're sitting right at those same levels. So if we're trading at COVID lows, we're trading at bear market levels. I mean, I would think the company is getting better, smarter, monetizing in some way, shape, or form, which they have a pretty large user base. So hopefully that is the case where, sure, things look better fundamentally. Fair market value is up in the 20s. Anything good on Snapchat would be pretty profitable. Okay, owning an airline is similar to buying a boat. I disagree. I think it depends on your airline. SkyWest didn't take a bailout during COVID. Delta is probably fundamentally, one of the better airlines. Like financially, they're pretty solvent. They're pretty flush, and that's about the only two I'd invest in. I'm in JetBlue and it's garbage. I've been in JetBlue since like $6. It's down to $3 and change. JetBlue might never pay for me. Southwest Airlines, I've taken some option trades on it. UAL, AAL, I've taken trades on those. They're okay. But if I'm looking at something where like I'm going to sell some puts, generate some income, Delta's fine, SkyWest is fine. But SkyWest is, I mean, we went from $16 to $135. That is a monster gain. That's an 800% move in the last year and a half. So not even close to being interested unless I could sell puts at like 20 bucks again, which I may or may not be able to. So let's find out. 82 IV rank. Let's see if I can trade this out to January. I mean, possibly I can. If I sold puts at 20 bucks, it looks like that's the lowest my strikes can go. December, lowest I can go. This is Delta Airlines. We go SkyWest. What? So I only have option chains out to October? You gotta be kidding me. Well, it's not good enough. Yeah, look at these premiums. These are terrible. If I want to go down and sell some like way out of the money premium, like out of the money puts, I want to own this thing at like the cheapest it's ever been. COVID lows at $12. Bear market lows at $15, $16. The best I can get for premium is going to be in like the $50 zone. That's not even close to where I want to be. So if this falls farther, I will consider selling some puts on on SkyWest. But Delta, I like the trade. Okay. All right. Any other charts questions? What else you want to take a peek at? Looks like I got another scammer on my Discord channel. Sweet. Here, let me show you how easy this is. Okay, this is why Discord pisses me off almost every single day, because all I want to do is have a channel that allows me to see everyone talking. You can talk to me right here in public, one to many. Everyone can talk to each other. Don't send direct messages. I don't send friend requests. I make that very clear. It's in my rules first, okay? But this is what I have to do every single week. I go to settings, I check for members, and there you go. There's an imposter right there. There's an imposter right there. Joined 10 minutes ago, joined 24 minutes ago. It's not me. I hate this crap. So let me ban for spam, and let me ban for spam. Bye-bye. Any other fakes? No. Nope, that's me. Okay. So anyway, you're all welcome to join my Discord. Just make sure that if you're talking to the channel that's public. You're talking to me, which I'm live in those channels every single day. Telegram, you can join my Telegram service channel as well. It's just live for everybody. Just when I go live, updates, chart alarms, alerts, updates with things like this. I was going to share this today. 1970s, early 1980s, generational buying opportunities was at low, not high valuations. This is one thing I wanted to start this entire session with today. Let's go all the way down here to the Shiller month by month, or the Shiller year by year. Right now, this big blue line is sitting around 33.48. Now, this goes back into the 1970s. These are current valuations of the stock market. Okay? So the last time that our Shiller PE ratio for the S&P was this high, it was the dot-com bubble. So is there room to continue to go higher? Yes, but man, I think a crash would be coming if we somehow went higher on earnings. If this is never going to get as high, and maybe it was just straight funny money and just the most euphoric, silly, crazy, stupid valuations ever in the dot-com era, maybe this doesn't get as high as that. But the question is, how much of the earnings compression is going to happen? Because we are sitting at like the second or third highest in like 50 years of the stock market. So there's a lot of history telling us that you're limited to the upside based on valuations. Okay. On a positive note, we have had a pretty big flush out with volatility. That is I'd say a pretty good buying opportunity out, 1, 3, 5 years. But this is also just another big question mark to add to 2025. If earnings disappoints through this quarter, we might see this revising lower, and then you just wonder, like, is it going to get worse, and how much worse is it going to get? If we go to the month by month, same price, you can just see a little bit more price action in between. So even during, this goes back to 1977. Why does this show 7702? Oh, interesting. So is this not even chronological? What the heck? That's weird. Oh, wait, this is 1902. My bad. So this goes back to like 1800s. All right, let's look more modern market here. So this is 1980s. There's your 60s crash. We got up here into the 90s. We had the dot-com bubble. So there's your dot-com bubble. Okay, 07, 08, we were already at higher valuations, but low compared to what we were in the dot-com bubble. We just continued to climb. So yeah, it's not a timing indicator. It just shows, like, by and large, stocks are still somewhat overvalued. That's all it really shows. Stephanie says, hey, when you say repair a stock, I average about 10 grand in losing positions. Can those be repaired? Well, what's your trade? When I talk about repairing a stock, I'm talking about typically taking ownership of something, adding covered calls, and I repair stock by owning the underlying. That's usually the easiest way to repair it. So, quick example for these last few minutes. Here, actually, you know what? Here's a better way to do it. Go to my YouTube channel. There's an options 101 video, long zebra. Yeah, that's similar to a synthetic. You buy 2 calls at 70, you sell 1 call at 50, you take a synthetic long, you have a debit. It's a little bit cheaper than trading the options by doing a synthetic like you did on Snap, where you buy a call, sell a put, same strike. The zebra side is a debit, so you can just get out of it without having unlimited risk. You get out of it with a max debit loss. Options 101. See if I can find. Oh, let me just go this. Gosh darn it. So come into my channel here and look at options 101. So here is, there you go. So Stephanie, this would be a good video for you to watch. Covered calls and turn losers into winners. So I'll post that link in the chat. Repairing trades. So it's spreads plus covered calls, or just tracking your break evens. And you can repair in all sorts of ways. You can take a loser and then just like do strangles or do iron condors and kind of chip your way at the losses and repair. But it's really just any assortment of trading active options around a position can help you repair losers. And I mean, it's nice when you think about it. Look, if you took losses, they sting, they dent your account. You have to build back from those. But if you have a plan B, plan C, plan D to work through a position, let's say I took a loss on whatever SPY. Okay, if I take a loss on SPY, if I have enough cash to own the underlying, I could repair the SPY in probably a month or so, depending on how big that loss was. Okay, for some reason, repair. Okay. All right, closing bell just hit. Bought a 620-500 SPY put and sold the 480 put for $3. What do you think? Well, that's $3 to get you 17 credit. So Larry, that's not a bad trade as long as your window's right. I mean, what you need on that trade is you need price to fall. And right now you're out of the money, right? So SPY's trading at 537. You have a 500 by 480. So you need price to fall back down to 480 by like as soon as possible, or obviously by June. So that's one way to do it. Personally, I would rather go out a little bit farther. I think right now this market, as far as the next big leg to drop, something tells me it's going to be like September to December. September to December, or September to even January of next year, just because that's the biggest window that combines. We'll have kind of round 2 of tariffs after July 4th or July 9th. We will have more earnings to discuss. We'll have the Fed starting to cut rates likely in June, July. Employment's really the big factor that kicks in to see, are we in a recession? Are we really slowing down? Do we have stagflation? What's our growth outlook? And are the Atlanta Fed GDP numbers as bad as they say they are? We might have 2 quarters of contracting GDP. Would that be something that's dictated as a recession? Yes, no, maybe, or labeled or defined as a recession? Maybe. So any hedges that I'm doing, I would likely go out a little bit farther. I personally would be going a little bit farther. And I know that I sacrificed some of the gains there. Like if I took the same trade you did, Larry, but price goes down here, let's say by June, July, August, I can still turn what was a $3 debit. I can probably turn that into a $7 to $10 credit and not have to wait all the way to that $20 expiration. Because the way that trade gets paid is you've got to time it really well, or you have to have price going below your 480 by expiration. And so you have until June to do that, right? Yeah, we've got a 620 expiration. So from your perspective, lower chance at a lower low until that time period. I mean, I wouldn't be surprised. I think that this is going to be an important low to kind of hold for the year, but I wouldn't be terribly surprised if we come back and revisit it. And I mean, I have no idea. I mean, realistically, the market could come up here and battle around. I could see the bears being really aggressive in here and kind of defending this like 580 level or 5800 level. But the big tell to me is that does this market, if the bears do step back in, does the market come in for a higher low, or does the market actually come back into these lows again? I mean, this was a terrible move. I mean, we had 4 crazy bearish days. Like futures was ripping, big gaps to the downside. The market is dumping. Volatility is screaming higher. I mean, we had the volatility index, I think, second or third largest all time advancement in a 4-day move. It was like third, I think, third of all time. And we also had one of the largest volatility crushes of all time. So very fast, very aggressive. And it was as bad as if we had a crisis. It was as bad as if we had COVID, or as bad as we had, great financial crisis. Um, so I don't know if the market's going to find a way to, melt up a little bit, find some real key resistance levels, and then sell back off. Is the sell off going to be a high or low? I mean, if I can turn that into profit, I might as well take advantage of something. I'd like to hang on to it to see if we can revisit the lows. But I think in order for us to get down to the lows again, to me, to get to this low, that low is going to be about earnings revisions, and unemployment. That to me would be how this gets worse. If we have a abrupt, ugly, aggressive earnings revision where it's like, look, the Schiller price to earnings at 33, it needs to be down to 23. Well, that could be a drastic revision in where these earnings are. If you go the price to earnings multiples on the S&P in the 20s right now, generational buying opportunities are not at 21 price to earnings. They're mostly at like 13, 14, 15 earnings. That's a long ways away from now. That would literally, we'd be talking about the S&P down to like 400 on the SPY, maybe 350 on the SPY, maybe 300 on the SPY. And I would put the SPX down to between 4250 and 3250. That would be a set it forget it long-term opportunity, buy and hold it for the next 3 to 5 years, and be excited about the future. I think for the rest of this year, it's going to be just a bunch of noise. Nobody knows what's going on. News can change in a split second. We say one thing, we do another. We do one thing, we say another. It's a super difficult market to feel like I've got a sense of direction, because I don't. So all I can do is protect, trade small, take my chances, take my stabs, trade good probabilities, and keep trading. That's really the best thing I can do. Okay. All right. Quang, my shirt, Swannies, swannies.co. Nice little golf shirt company I've been a part of for a while. I'm a little PGA ambassador. Maddie says, your perspective, lower chance at a lower low until that time period. I mean, I don't know, man. I mean, does anybody want to see a lower low? That's what I'll ask you. Do you want to see a lower low? I mean, technically, sure, we can come to resistance here, and the bears can fight back, but it's like, do you want a lower low? Do we want the VIX to go to 60 down to 29 and then back up to 60 again? I mean, that would be like head spinning volatility. Nobody wants that, and we did see that the government, okay, the Trump administration was willing to jawbone the market. And I think at the very least, like, that is a level that will matter. But if we do break the lows, we're going to see the bond market probably breaking in some way, shape, or form. The Fed is not coming to the rescue. I'm sorry. They're not coming to the rescue at 480. They're not coming to the rescue at 4,800. The Fed wouldn't touch this market with a crap ton of liquidity, with trillions of dollars, until we're probably 35 to 50% lower from the all-time highs. That's it. So, I mean, what's a year to date? I mean, we probably have to be down 25 to 35% year to date for the market to say, hey, maybe the Fed can step in. But from the all-time highs, if we're 35 to 50% off, yeah, sure, maybe the Fed steps in. It's the same song and dance. It's more, liquidity, but it's just going to be more money. That's the stupid thing. It's like, this is not a sustainable way to play the game. But right now we have absolute power, and we have the world reserve currency, and we have the printing press. And until that power is taken away, it's probably in the toolkit. But I don't think it's at these lows at a 21% correction from the highs when valuations are still at 21, 22 times multiple. It's not. It's just not. It's going to have to be 16, 15, 14. but we could be way, way, way lower for that. So this earnings season, as you know, and it may not be like super lucrative because we came off of these massive volatility swells and then they're crushing right now. But if earnings just comes in okay and guidance is okay, I'm giving it, like, let's say it's 51% positive and 49% negative. Maybe it's enough to show some resiliency, but we don't want to see earnings that's like 100% negative. I mean, I think that bottom on Wednesday certainly helped a little bit, but it's going to be challenging. The whole environment is going to be challenging. I don't know if what just happened is a good thing. I really don't. I think there are. I mean, look, how do companies make the most money? They pay the least amount of labor. They try to create products, services that have the highest margins, and they want to make bottom line profits. That's corporate America. That's the S&P 500. That's the best fundamental performance of any company. So if you're going to do things that tap into those margins, that force them to pay more for goods and services, or they have to pass that on to the consumer, these are not good. If you're forcing them to go from what has been globalized with free trade and less friction, where they can make things in a different country for cheaper than what we can do here in the US, but they can sell it to the highest bidder or the highest consumer, that's good for profits. All that's changing. You know, if you're going to force Apple to make phones, chips, tablets, pieces with US workers asking for $50,000 to $60,000 minimum income, when you can do it for $6,000 for a Chinese worker, that's coming out of Apple's pocket, and that's bottom line. So that revision is going to happen if that's the case. So that's the next big unknown. Is I don't think we can sustain these valuations. They're really high. But it depends on how aggressive these revisions are to the downside. How aggressive? I don't know. Okay. Yeah, maybe. I mean, yeah, but we're about to tariff pharmaceutical companies. I mean, I like Pfizer too, but what is it about the stock that sucks? I mean, we're back below COVID lows. We're back below bear market lows. We're back below 2024 lows. What is it about this stock? It's like there's something going on here where Pfizer's just not performing. So I don't want to throw a bunch of dead capital at it. If I'm going to get long Pfizer, it's going to be down here at 2008, 2009 lows. I own some shares. I have some diagonal spreads. I own some shares. There's defined risk there. That's fine. I'm going to keep chipping away at my trades. But let me see what else I have here on Pfizer. So I have shares. This one. So this covered call it's about 83%. I could just dump it and move on and take a little bit off and just move on. I don't think we're coming back to $29 the next 31 days. Or I can just roll this into something else. I've collected about 83% to be more capital efficient. I could probably just roll it into something else, chip away at it. So my debit's about $7. So anything at 27, that's, I could lower it. But I'm out to June of 2026. And where would I get long on Pfizer? We come back to 2008 lows. I'm going to get long on Pfizer. I mean, this is another stock that you would think has some upside potential. Fundamentally, it's pretty good. Yes, it has debt. I mean, it's got a dividend. It's going to fluctuate, but I mean, a 7 to 8% dividend is not terrible. Earnings forecast to grow way below estimated value. Price to sales, price to earnings. I mean, price to earnings 15.6. I mean, yeah, give me something good on Pfizer. But if you're going to buy Pfizer now, you got to be prepared to take this thing down to, $12 too. So if I bought some shares here and I bought some shares here, sure, that's a good spot to say, yeah, longer term, I like Pfizer. Maybe it comes back into the same level, pull back to this big fib zone. I mean, is this a fifth wave? 1, 2, 3, 4, 5. Whenever this is going to settle in, yeah, I like this spot. We get a ABC correction, come back to here, come back to here. There's a time and a place for me to want to get long. I just don't think it's now. If I buy now, I've got to be prepared for level 1, level 2, and be prepared for another $10 lower. If it comes back up here and forms a bullish pattern, then Pfizer looks great for a move back into the 30s and 40s. Right? But right now, pharmaceutical companies and pharmaceutical tariffs coming, probably not a good sign. And it's going to hurt until the coast is clear. And I don't know what that looks like. So I think a lot of this is overblown. Fundamentally, it's probably still fine. But anyway, that's what I've got to be prepared for, is if I'm doing anything to take action now, it still has been lower. It could still be lower. But I do think overall it's a strong company. Latest volatility mainly caused by Trump's tariff policy, which is still very liquid. I'm not sure what that means, Patrick. The more volatile we see the markets, the less liquid we see. There's less liquidity when the market is uncertain, right? So, I mean, if we're going to add liquidity, it's like that's going to ask from the Fed, that's going to ask from investment banks, that's going to ask from hedge funds. You've been possibly reading about something called the basis trade, which is part of the reason the bond market was so disrupted last week. Liquidity from like the top core level has been disrupted these last couple of weeks. That's not a good thing. We could have less liquidity moving forward, and the U.S. has always been one of the most liquid markets in the world. So it is starting to see some dents, and that fragility is not good. Pfizer, a buy put debit spread. So you want to short Pfizer, Pete? I'm not shorting this stock. I mean, I want to get long. It's just, I mean, if I did a credit spread, sure, maybe take the assignment. You know, we do have earnings. Did we have earnings? Pfizer has earnings towards the end of the month. So I wouldn't mind looking at something on Pfizer. But if I did a credit spread, let's say I did like a 23 by 22 and price goes lower. Well, am I willing to ride this down, take on the shares, lower my cost basis, and then try to ride this lower and see if I can get a discount and then maybe repair it? But if I'm going to get long on Pfizer, it's going to be down here towards the great financial crisis lows. So, all right. That'll do it. I'll let you go for today. Back at it tomorrow. Thanks, everybody. If you are not subscribed to the channel, kindly do so. Chris Pulver, so youtube.com/Chris Pulver. You can subscribe. If you have any questions on these videos or any questions like Stephanie asked today, I do have a bunch of content. I think I have over 880 videos. A lot of them for the last couple of years have been live sessions like this, the final hour, but I probably have 70 to 80 just straight education videos. You can see them here from equity management, support resistance, leverage trend lines, keep it seriously simple. There's a whole video series there, and on we go. So take a look. Trading 101, keep it seriously simple. Good timeless education in all sorts of different asset classes, using brokers, using indicators, and then we're live a lot through the week for this final hour session. So kindly subscribe, like the content. If you comment on the videos, that goes a long way. Any engagement is good. That's what helps the algorithm, and that support is what helped me grow the last 2 years from 0 to 9,000, and hopefully more organic growth coming. So hopefully this year we're hitting 10K, and we'll just continue to see that hockey stick its way into more followers. Okay. All right. Sounds good. I will see you tomorrow, everybody. Thanks. Bye.